Welcome to the Friends with Money podcast, brought to you by Money Magazine, creating financial freedom for Australians since 1999.
Hello, and welcome to the Friends with Money podcast, your weekly pod to help you earn, save, and make more money. My name is Michelle Baltazar, editor-in-chief here at Money Magazine. Thank you for joining us. With the cost of living crisis still hitting a lot of people hard, research has shown that a lot of people are now foregoing insurance. We're talking about people who are skipping paying for life insurance altogether. Is this good or bad? Can we skip it for a few years until we get our finances on track? Or is that a dangerous thing to do? And what's this thing they call insurance inside your super fund that a lot of people don't know about, and insurance outside super? To talk to us about this is our guest, Melisa Sloan, author of a new book called Big Moments, Expert Advice for Conquering Those Moments That Define Us. Melisa, thank you for joining us.
Thank you so much, Michelle. It's a pleasure to be here today.
I'm so happy to hear that. Just a bit of background, Melisa is the founder of Melisa Sloan Lawyers, a member of the Law Institute of Victoria and Victorian Women Lawyers, and she's also on the board of directors of Expression Australia. So I'm going to hit you with the first big question. What is this thing they call insurance inside super and also outside super?
That's a very good question, Michelle. It really depends on your circumstances whether you should hold your insurance inside or outside of superannuation. Some of the advantages of holding insurance in super is that there's lower premiums. The convenience of payments are automatically deducted from your super balance. And it can also be really tax effective in that the premiums are paid from your super balance, which is taxed at 15%. And this is usually lower than the marginal tax rate. There's also fewer health checks, as most funds offer a default level of cover, and you do not have to undergo health checks. In addition, for most insurance policies, it comes with a default level of death and TBT insurance, negating the need for endless paperwork. However, what we need to be aware of if we are holding insurance inside super, that there can also be some disadvantages, including that the default insurance provided by the fund is not tailored to your specific circumstances and may not be suitable to provide the adequate level of cover that you need for your individual circumstances. It's also eating away at your super balance. And if the account becomes inactive for a period of 16 months, your insurance cover may actually cease. And that's something a lot of people don't know. The other thing is there's usually a greater level of cover that you can obtain outside of super as opposed to inside of super.
Let me just pause there because there's a lot of information there. So just talking about inside super, three things that you've just said to me. One, I mentioned this to my brother who owns his own business, that if you stop putting in money into your super for 16 months straight, because he's moved from being salaried to now owning his own business, you do lose it. And no one talks about that, right? So it's 16 months. You get like a year and 4 months. And it could be as little as $20 or $50. Is that right?
That's exactly right. A lot of superannuation do allow you the option of continuing with that insurance, but you need to notify them that you want to continue with the insurance. If you don't, and you don't make a contribution, your insurance is cut off. And a lot of people are not aware of that and are caught out by that rule.
We don't get an email saying, hey, a month from now, your insurance might get cut off. The onus is on you to tell your super fund or to make sure you look after yourself and don't have this expectation of insurance, but in fact, you voided it because you didn't know about this rule. Now, secondly, you also mentioned that it's almost like a blanket insurance. So if I was, let's say, 45 years old and I've got a new job, they give me life insurance within that super, but I don't have to do like a health check. And I don't have to disclose pre-existing illnesses or anything like that. But it is, like you said, it's kind of a blanket insurance. It's not really specific to you.
That's exactly right. And that's where so many people get caught up. Because what they do is, they start a job, they get their superannuation form, complete them and send them off without really looking at them. And so it's really, really important that you look at those forms and look at things like the product disclosure statement just to make sure that you are adequately covered. Because again, the onus is on you to provide the insurance company with any information that may be crucial for your policy, like, pre-existing ailments or anything like that. So it basically, inside of super, it's a one-size-fits-all. Outside of
Yes.
super, it's much more customized.
All right. Okay. But come on now. Who reads product disclosure statements? It's a little bit of an effort. But I would say that based on our previous episodes, we have encouraged our listeners to call their super fund. And that way they can just ask questions like a normal person to say, hey, tell me more about my insurance, or where do I find out information about that? So that is probably something that they can do.
Absolutely.
Let's move on to outside super. This obviously means you have to fork out your own money to do that. But what are the pros and cons?
By holding superannuation outside of super, it provides you with more cover options. It's more customized, and generally it provides a higher level of cover, and your premiums don't eat away at the balance of your superannuation fund. It's really important to get the most appropriate advice. So there are insurance agents, and there's also financial advisors who can actually assist you in looking at the best product or the best insurance product for your needs outside of super if need, so that you can make an informed decision about what the best cover for you. The other thing to also remember is that if you hold superannuation inside of super and you have superannuation tax dependent, that's a very attractive proposition. But if you hold superannuation inside superannuation and you don't have superannuation dependent, which can be a spouse, a child under the age of 25, or a disabled child over the age of 25, or someone who's financially dependent on you, the actual insurance payout may be taxed at a greater rate. So for a lot of people who do not have those dependents, they hold their their insurance outside of super, where when it's actually paid out, the taxable implications are much more favourable. So that's why it's really, really important that when putting these in place, people seek the appropriate advice.
I love that. Again, no one talks about it. So inside super, there are tax consequences if you don't have a spouse or you don't have kids. And always seek professional advice. But we've always been a big fan of the fact that super funds do have a general advice contact center. You can just start with that and see how you go, but definitely seek professional advice on this, because we're talking about what, tens of thousands of dollars? Or are we talking about a few $1,000s? What is at risk here?
It depends on your insurance balance, really. If you have a high insurance balance, it can be quite substantial. And I'm talking, if someone has $1 million in insurance, the superannuation can be taxed at 31.5%. So that's kind of like hundreds of thousands of dollars. So it really, really depends on what the balance in your super is. That's why it's really important, really prudent that you get the appropriate advice there.
Now, if there is one acronym that I hope all our listeners will be familiar with straight after this episode, it is this thing called TPD. What is it and why should we care?
TPD is total and permanent disability insurance. And it's a type of insurance that allows you to receive a lump sum if you suffer a permanent disability due to an illness or disability, and it's deemed unlikely that you will never work again. So by having TPD in place, it allows you to continue to support yourself and your family and to pay for all of those ongoing medical and rehabilitation costs that you may incur.
So this is really for instances, and we don't want to think about it, right? Like a car accident and you can no longer work, or it could be a work-related accident, especially for those who are in construction, for example. This is handy to know. TPD, total and permanent disability cover, which you can get inside and outside of super as well. Is that right?
That is absolutely right. And it basically is for if something happens to you and you don't have the funds to support yourself, you should make TPD a priority. Because if you don't have it in place, it can result in an enormous financial stress to you and your family. And prospectively, it could mean the loss of your home and other assets. It's important to note that most TPD policies have a minimum waiting period of either 3 or 6 months before you receive payment. And it's also really important to read the product disclosure statement. I know you said that not many
Here
people
we
read
go
it.
again with this PDS, product disclosure statement. Yes.
Yeah. And the reason being is to check whether it offers any occupation TPD insurance or own occupation insurance. And the big difference here is whether the claim will be paid out. For example, if you have an own occupation TPD insurance, it covers you if you cannot work in the job that you had before you suffered the injury or the disability. And while this cover is more expensive, it can be easier to claim, and consequently, the claim is more likely to be paid. If you have any occupation TPD insurance, it's likely to be cheaper to purchase, but it's also harder to make a successful claim, as you must show that you are unable to work in any role aligned with your experience, education and training. So, for example, let's take Bob, who is a really super fit tradie. He suffers a serious injury, which
Right.
precludes him from working as a trader in the future. His injury does not, however, preclude him from undertaking, for example, an administrative or clerical role. So if Bob had a TPD insurance of own occupation only, then it's unlikely that that claim would be paid out. So that's one thing that's really, really crucial. A lot of people are not aware of the difference between those two, any occupation or own occupation for TPD.
Why do they make this hard, mate? Why, Melissa? So it's
I have
owner
no idea.
occupation. What is it? Owner occupation and own occupation?
That's exactly right. Any occupation or own occupation. So basically, yeah, that are the two. And that covers you. Own occupation covers you if you cannot work in the job that you currently have. That where it's normally going to be paid out, more expensive. But if you have any occupation, that means you can work in any other job
Uh,
apart from the job that you're currently doing at the moment.
what do you have as a default in your super?
It really depends. It really depends. That's why I know you have to read the product disclosure statement just to make sure that it is covered. And that's why usually with the mass ones, it's the cheaper one because it's cheaper and people just don't look at it and they think that they're covered. And it's not until that time that you got a claim that you're
Yes.
actually not covered at all.
Okay. All right. So it's any occupation and own occupation.
Own
And
occupation.
I think the takeaway for me here is that no one can escape the product disclosure statement. We really just need to see this as one of those documents that we have to read. But again, maybe some super funds can show you what you have in your app or calling them. But it is one thing that you have to check certainly. So you make sure that you do get the insurance when you need it. Now, I'm afraid that's all we have time for today, but I feel like that's enough. We know about inside super, outside super. We now know about TPD, any occupation, own occupation, and finally, the product disclosure statement. But finally, anything else though that you just want to kind of tell people who are listening what they need to know about their insurance?
I think one of the things that to keep forefront of your mind, particularly in today's, cost of living, is try and maintain your insurance if you can. We don't have that crystal ball. And the most important thing is to protect yourself and your loved ones. Without it, it will make life a little bit more difficult.
Well said. Once again, thank you for joining us, Melisa.
It's been my pleasure. Thank you so much for having me.
Now, before we go, if you enjoy listening to the Friends with Money podcast or this episode, please share it with your friends and family. Like Melisa said, make sure you check your super fund and that you have the right insurance cover. You've got a finance question you'd like us to cover in future episodes, drop us a line on podcast@moneymag.com.au. Until next, I'm Michelle Baltazar. Bye for now.
Thanks for listening to the Friends with Money podcast. For credible, independent, and easy to understand financial commentary, visit moneymag.com.au. Please remember that the views and opinions expressed in this podcast are general in nature, and further independent advice and research based on your personal circumstances should be sought before making an investment decision.